what is the, between 17 and 2022, whatever money has been created, market cap has been created, we have reduced the amount of money company by chance has raised, that we have reduced to the net wealth created for share buybacks and dilutions. So this 5 years, the net wealth created is 92 lakh crores. By these top 100 companies, 92 lakh crores of wealth has been created. This is by far the largest wealth creation in a 5-year period, between 70 to 22. We have been seeing from in 2001 to 6, it was 14 lakh crores. Then it became 16, 17, about 20s and 30s. And then it was more like 70. Last year it was 70. And now this has climbed to 92. I'm sure this number will keep climbing as the size of the market grows and pace of the wealth creation increases. And hopefully we are going to see more than 100, 200, 300. Today, market cap is about 280 lakh crores. I'm quite sure in next, say maybe in 10 years' time or 12 years' time, you'll see in one 5-year period, 290 or 300 lakh crores being created in the marketplace. That's the power of this market, and it is a very consistent market. We'll talk about it as we go forward. Then the pace of wealth created. I mean, not only that size of wealth created is largest, this pace of wealth created is also fastest. It is at about 28% compounded, whereas the market has done at about 15%. So almost all the wealth creators, they have outperformed the benchmark by 10 to 15%. So even you look at it, Reliance has done it at the rate of 32% compounded, TCS has done it 25% compounded. We'll see that data. So it's not, don't focus too much on the market. Right now, the talk about the market is so much. What's going to happen in the market? Where the market is headed? At what pace market is going to grow? Everybody is focused in the market. Nobody is focused on the stock. Very few guys are focused on the stock. So this is the time in country like India, which is very consistent. I think you've got to be focused a lot more on the stocks than the markets. So which are the biggest wealth creators? Hold your breath. Reliance Industries at 13 lakh crores. In just 5 years period, 13 lakh crores has been amassed by Reliance at the rate of 32% compounded. And the P multiple, which was 14 in 17, has become 30 in 22. So the company has grown at about 32% compounded. The earnings have grown about 14-15%. If you look at TCS, has created about 9.5 lakh crores of market, and it has grown at 25%. These are very large companies, but the pace at which they are creating wealth. HDFC Bank, another 4 lakh crores. Infosys, another 5.5 lakh crores. Bajaj Finance. So Bajaj Finance has grown at about 44% compounded. So all these, they need to be called out. ICICI Bank, Adani Transmission, Hindustan Unilever, Bharti Airtel. After 10 years or 12 years, first time Bharti is making an entry into the big list. And Wipro. So these companies, they have on an average created wealth at the rate of about 27% compounded in the last 5 years. And they are literally 50% of all the wealth created. So 92 lakh crores has been the total wealth created by top 100 companies. Of that, 49 lakh crores, so that's about 55-60% of that has been created by this top 10 companies. So pace and the size of wealth creation is becoming kind of a K-shape. The top companies are creating bulk of the wealth in the last 5 years. The fastest wealth creating companies, the top 2 Adani companies have been top of the charts. Adani Transmission and Adani Enterprises. And below that, you have Tanla Solutions and other companies are also there. But this particular category had always been, kind of little notorious in the sense that the companies, if you're lucky to have any of these companies in your portfolio, they are more of a lucky strike than by design you can have these fast companies in your portfolio. And any one of them in your portfolio of 3-4% also, I think you don't have to worry about the future. You can retire with that particular inclusion. But you got to be smart and lucky to have these companies in your portfolio. And literally, to appear in this list, the companies have to double at the rate of, literally it has to double every year. And another thing is that the 7 out of these 10 companies, they were literally, they were very small in 2017. They're about 3,000 crores or lower. So to find real multi-bagger, like everybody asked me, give me 1 or 2 multi-baggers. I said, if I have any multi-baggers in my hand, knowing that this is going to happen, then of course I would be God. So of course, nobody knows which is going to be the multi-bagger. Hence, one has to be careful. One has to be careful about trying to find these companies. And don't hesitate to buy into small and mid-cap companies which are ignored by the market or not known to the market about the story. Typically, these stories are undiscovered stories and completely unknown to the market. And that's where the ignorance and apathy towards these companies, that leads to when the companies do well, the stocks do well, like unbelievable. Then you have the most consistent sector where we are saying of the companies which have done well, every single year, 5 years out of 5 years, the companies which have beaten the stock market indices, because you can beat in 5 years back-ended, front-ended, but every single year to beat the market is not going to be easy. So Adani Enterprises has literally doubled every year in last 5 years, but the earnings have degrown by 4%. So it's all because of re-rating. The company has done well. Then you have Alkyl Amines, Coforge, Mindtree, L&T Infotech, SRF, DVs, all fantastic companies which have grown their earnings at the rate of 25 to 35%. And of course, there has been again re-rating. I think re-rating has been a common phenomenon across the successful companies here. So not only you have grown at 10, 15, 20% their earnings, but anywhere between 5 to 10% compounded the re-rating has happened. And that has been the source of what you call mega size wealth creation. Maybe probably the re-rating has happened because of the low interest rates. Till about 2 years back, the interest rates were zero. So it fell from 3-4% to zero, and that led to equity boom all over the world. And we saw all kind of irrational activities in the loss-making companies, startups. People, last year digital companies went through the roof because discounting rate came down significantly, and that led to a lot of even good companies being discounted. Instead of 50 times, they got discounted at 80 times, 90 times, 100 times. That's the only academic explanation I can see. But what else has happened in the market? Is it the supply? Is it the manipulation? I don't know. But I think one running theme is that the re-rating has happened in last 5 years, which is completely unprecedented. And all-round wealth creators, the companies which are biggest, fastest, and consistent, all 3 ranks we have added up, and then we said total of the ranks, the lowest one are the ones which are the most all-round wealth creators, I would say. And Adani takes the cake this time between number 1 and number 2. They are the ones, and then after that you see L&T and L&T Infotech and Mindtree, Divi's Lab, SRF, Bajaj Finance, Reliance Industry. To come here, Reliance Industry, that's some achievement. So because typically, very large companies don't make it here. So this company, because it has done at the rate of, it is by far number 1 in terms of biggest, but even speed is not that bad. It is more like a 44th rank. So that has brought it here. And so a lot of things which were not expected has happened in the marketplace in last 5 years. Now we looked at the, just get some water. By industry, which are the industries which went big in last 5 years? So technology, IT, has been the biggest wealth creator. Out of 92 lakh crores, 25 lakh crores has come from IT. And this industry has been consistently creating wealth in last 25 years. Last 22 years, there is no year when the industry profit has degrown. So it was the industry was about 1% of the total profits in 2001. Today it is 14% of the total profit. So this is what has happened in last 22 years. So this is one of the sectors which is backbone of the Indian industry's march in the stock market. And you have fabulous companies like TCS, Infosys, SCL Tech, Wipro, and now L&T Mindtree is also shaping up as the fourth or fifth largest company. So Tech Mahindra. So these are very large, extremely well-run corporations. Then you have the banking and finance, which were in doldrums in last, say just before COVID. I think COVID was the last, what you call, shock to this sector and cleaned up, but still it is the second largest. And then you have consumer and retail and oil and gas. So these are the four very large segments. Oil and gas is nothing but Reliance. So Reliance is a sector in itself. And but I see that telecom and realty, these are two sectors which are coming out of despair. You know, and this particular thing, when it is coming out of despair, has the potential to make a significantly larger amount of money in the years to come. I mean, it is just when I'm looking at data, it is looking like a very predictable kind of a scenario for next 5-10 years, because I have seen telecom is a very consistent industry. The demand is day to day, it's very essential. It is just that fighting in the competition among the 2-3 players that brought down this industry to literally a well destroyer. So we'll talk about it a little more, but it looks telecom in reality in next 5-10 years could be very interesting segment, though it's small right now, but it could add a lot of wealth in the years to come. Public sector, it used to be about 35-40% of wealth creation was by, and look at number of companies which were participating till 2005. 25-30 companies used to be the wealth creators. Today, one company has participated with literally zero wealth created. This is data till March 22. In 6 months, a lot of things have happened. PSU banks are flying. Many other defense stocks are also doing well. So maybe, I mean, this is the worst of PSUs, and quite possible as we go forward, at least better days could be there. I mean, it cannot be worse than this. Zero number of companies, zero wealth creation. So I think the ultimate contrarian buy or a trade, I would say, this is a complete despair, discarded valuation, and companies are not. I mean, so this shows the apathy towards the companies run by government. I think government is also, what do you call, they're trying to get out of this. So maybe a wiser counsel will prevail, and they will try to be a little less hostile to their own companies, and maybe I think better days are ahead. But very stark, from 49-50% to literally zero. I have never seen any chart like this as what has happened in last 15-20 years. Then the wealth destroyers, the companies which have destroyed, this is about 14 lakh crores of wealth destruction in last 5 years, which is very large number, but it is amongst the smallest number for the size of wealth created. One side, you have 92 lakh crores wealth created by 100 companies, but another 14-15 lakhs destroyed by Vodafone Idea, 127, IOC, Coal India, Yes Bank, another 66,000 crores by one bank. So India Bulls Housing. So there are kind of, but very good names are featuring here, which have lost money for one count or other. So that is the first part of the study. So let's look at the theme of the report, consistent and volatiles, 2 dimensions of wealth creation. So there are 2 types of companies. I mean, very simply put, the companies which in a predictable way, they, year after year, they keep making money, and larger amount of money are the companies, we call it consistent, and the companies which are not consistent are volatiles. And let me tell you, 80%, 85% of the companies, if there are 4,000 companies, 85% of the companies are volatiles. And so I personally used to think that, in fact, our logo is also buy right, sit tight, and QGLP, and that is silently applicable to consistent companies. That I was not aware. I could feel the difference between a consistent company, a secular company, then a cyclical and volatile companies, commodity companies. But I was not able to think very clearly what are the rules of investing in a consistent company and what are the rules for investing in volatile companies. We'll talk about it, but that is the biggest learning what we have, because you can differ how I define the consistent companies. You can have your own definition. but you can't take away the core of the thought process that the companies which have predictable earnings has to be seen very differently, and the companies which don't have predictable earnings, जो दिखता है वो बिकता है. So if you don't have predictable earnings, your market is not going to give valuation, or it is going to be extremely volatile for the wealth creation. So the whole process started with reading of the book called Mastering the Market Cycle, and it's quite a book. I would suggest that everybody should read, and extremely well written. And he had come to India also. We had listened to him. But initially when I met him and when I heard him, I thought this is not for me. I am not this type. And then as the time passes, you realize that what you think is not relevant, it is definitely relevant to you. And that's where, we thought that let's do the study, because when you study, you go deeper into that. So what he's saying is that we cannot know where the cycle is headed. Everything is cyclical in life. We cannot know where the cycle is headed, but we can surely know where we stand in the cycle. Are we at the top of the cycle or we are at the bottom cycle? That at least we can know and decide our strategy based on that. Second thing he says, if you can't predict, actually nobody can predict the future very clearly. If you can't predict the future, you should know the past deeply. We can know the past very deeply. And that is where the differentiator comes. When you pick the stocks, we don't do enough research about the past. 10, 15, 20, 30, 40 years. Now with the digital database, what is not available? Everything, every corporate action, what has happened to the financials, what has happened to capital allocation, how they're disposed of, how they're dividended, everything is there. We got to know, and you will know a lot by reading the past, because that is what is going to decide the future. And maybe while reading the past, you might get some semblance of the future also. We tried to apply the idea of cycles in Indian companies, and there we found that the cycle word is not right. I think because you got all kinds of things. 1 year it goes up, second year goes down big time, it goes to... So we found it very volatile. If you ask me, if the company is not consistent, they're all volatile. They could be cyclical also, but the companies are not predictable. That is what is the better word. So we called it consistent and volatile. And these are two sets of companies. So the way we have defined, because for lack of, visually we can do individual companies, but we said we want to run a data set. So how exactly we define the consistent companies? So here, consistent we defined over a 15-year period. We said 2007 is a good period for 15 years, because 10 years will be short. Let's look at 15 years. So 15 years, all the companies which are listed in 2007, we took all those companies and we said, let's bring a little significance. So we said any company which is more than 100 crores market cap, we will study all of them for next 15 years. So that's how we arrived at about 697 companies, and no other filter, just the little significant companies, more than 100 crores since 2007. And those 700 companies have been the part of this study. And the annual profit after tax should not fall by over 10%. We said, some company, after growing for 4-5 years, if it comes down by 5-10%, we should not call it inconsistent. So we said, let's give a band of 10% for calling it consistent. Then we realized that because of COVID and various other things, in corporate history, always something or other happens where the drop of the profit is more than 50%, but basically the companies are consistent. So we said, for every 5 years, we'll give one drop of more than 10%, but not more than 50%. Because the company can have a 100% drop and then again journey starts. So we said in 15-year period, PAT should not fall by more than 10% for the more than 3 times and 2 times in 10 years. And no fall in PAT of greater than 50%. Any company like Bajaj Finance fell by, I think, 65% in COVID period. We called it volatile. But basically the company is consistent. But just to maintain the purity of the study. So that's what I'm saying. When you look at a company, you can decide for yourself what changes, what adjustment to make. And we said terminal year should be higher than the starting year, so that you don't get a company which is completely junk. None of the companies were junk when we did the study, but still, as a caveat, we just put it. So all companies are not consistent, are volatile. So here is the, let me explain you. So HDFC Bank turned out to be the only, I mean, these are examples of consistents and volatiles. I mean, various types of it. So HDFC Bank, if you see, it's a perfectly consistent company or a bank. From 2008 to 22, every single year, 40%, 41, 34, 33, 31, 31, 27, 22, 20, 19. It looks like magic. I mean, it looks like it is unreal. But this is what is the number which the managements have delivered in last 25 years. 15 years, and even you go to 25 years, the numbers are same. Actually, the initial year numbers are even bigger. So that is the epitome of, I would say, consistency. Now, second, SBI, very credible bank, 22-23% of entire banking market share. 41%, 22, 7, and then minus 7. 40, 17, minus 21. 20 plus, minus 28, minus 100. And then it got into loss. And then from loss to profit, and then the recovery is very rapid. And now it is making record-breaking profits. But it is very volatile. Very volatile. So this is volatile. I mean, there is a largest bank which is volatile, and second largest bank, HDFC Bank, is absolutely consistent. So from one industry, same opportunity, you can produce two different kind of results. And markets clearly value it in a very different way. Very, very different way. So Ultratech, it is a very kind of a commodity type of industry. Only one company which is kind of a consistent. If you look at it, there are 2 years when it is broken down by 19%, 11%. So since it crosses 10%, we call them, it is absolutely bordering the limit, but still because of that 3 drops, it is consistent. Sri Cement, on the other hand, has done very well otherwise. But look at the reporting, 68% drop, 11%, 47% drop. And again, next year it comes back. So these are the companies which, for some reason or other, have decided to report the way they have reported. Cummins, to my surprise, it's a capital goods company, has just broken by 12 and 13%. Then you have ABB, which is kind of a little more volatile, with 82% drop in 2011. I don't know this number, but this is how the companies have been. Reliance, again, epitome of consistency, just 2 drops in 15 years of 2% and 5%, which is within 10%. So this is also super consistent. I would say after HDFC Bank, if there is anything consistent of the size, it is Reliance. And in the same sector, we have tried to bucket it within the same sectors. And then you have the BPCL. Look at what is happening there. It's all over. Minus 51, minus 53, minus 14, minus 40, minus 13. I don't know what will it be for 23. So that inconsistent leads to unpredictability of what will be the profits in the years to come. And that distorts the mind of the investor and the markets. So we put together some 15, 17 kind of characteristics of both of them, consistent and volatiles. So typical nature of the business is secular in consistent and volatile is cyclical. Industry leadership, almost guaranteed. 85 out of 114 companies where industry is number 1 or number 2 in their respective field. That is absolutely, I mean, most of the leaders are, because of their consistency, they go to the leadership position. So mostly leaders, and so all the consistent companies are leaders, but all the leaders are not consistent. Just listen to this. And volatiles, because they are not getting the leadership, they are more like a follower or smaller companies. Then you have the pricing power. I think the biggest source of what we call consistency is the ultimate pricing power of the companies. And the other side, the volatiles, they might be doing big business, big profit, but they may not have the pricing power. Competitive landscape, very favorable and unfavorable here. We'll get to the examples later on. Business strategy, very strong value proposition, and the weak value proposition in the same industries I'm talking about. Excellence in execution. This is the core thing. In India, opportunities are galore in every field. The managements which can execute are the managements which are going to win. Then we are talking about influence of government regulations. I think that is the biggest thing. Wherever governments are regulating a lot, they are putting for every damn thing you are going to the government. Those industries are, they are not able to grow, or they are not able to show consistent performance. Like look at HPPP, IOC and those kind of stuff. Then we are talking about future earnings, relatively more predictable, and here it is unpredictable. Average return on equity very high and relatively low. Debt equity low, relatively high. Dividend payout higher and lower. Valuation approach, earnings based. Because you can predict the earnings, P multiple should be used only in those companies where earnings are predictable. Because DCF works, cash flow works, you can do any discounting, dividend discounting, earnings discounting, free cash flow discounting, operating cash flow, because those things are predictable. The companies where it is not predictable, you have to find some other way, and that is the asset-based valuation, capacity-based valuation. So fundamentally, you have to change the way you look at the companies, and markets are very smart. It's not that market doesn't know, it's that we don't know. We have to change ourselves rather than market. Market is very smart. Market is at the top of the profit cycle in commodity companies, they give you 3, 4, 5 P multiple. And we wonder why the P multiple is so low when the index is at 22 P multiple. It is because of this, because they are unpredictable. And market valuations typically premium to the benchmark. We are not able to understand why these consistent companies are 2x, 3x, 4x to the market, whereas a lot of these commodity companies or volatile companies are at significant discount to the indices. And valuation range very narrow. These companies, they are not only expensive, but they move in a very narrow range. Whereas the volatile companies, they move in a very wide range. And compounding, the consistents are very strong compounders, whereas these are very weak compounders. And percentage of Nifty market cap, hold your breath, 72% of the market cap of Nifty are consistents. Only 28% are volatiles. So sources of consistency and volatility. So industry level factors and company specific factors. So look at it, nature of demand. The fundamental thing is, if the nature of demand is consistent, you are going to get consistent possibility of a company. It is not a guarantee that in a consistent demand, consistent industry it not necessarily produces consistent companies. There are many more things, but first thing is top line. If you have a consistent top line, you have a chance to produce a consistent company. So look at Indian software exports. From $4 billion in 2000, it has consistently grown at 12, 18%, 19% to become 176 billion this year. And current year it expected to cross 200 billion in a very predictable fashion. And everybody is saying, look at all the studies, they are saying that we are going to hit 350, 400 billion in next 5, 6 years. That is the core of TCS, Infosys, Wipro, because they have, in this kind of opportunity, they have that prowess to execute. And incidentally, even TCS PAT has grown at 18%. And if the nature of demand is volatile, like truck demand, is very volatile. Companies, the best of the companies can do nothing about it. So look at Ashok Leyland, which is a well-run company. I mean, telcos, even the automotive division, is also extremely well-run. But you can do nothing if the demand falls by 30, 40%. So that is a source of volatility. Second, competitive landscape. This is one thing which is silently plays in the backdrop, but favorable competitive landscape will favor consistence and vice versa. When all the forces, bargaining power of suppliers, buyers, new entrants, threats from the alternatives, and the competition, I think most important of that is right at the center. If the players within the industry, they fight like cats and dogs, nothing can hold that the industry's fortunes. So in paints, in housing finance, and various other industries, there are multiple players, and yet they create a lot of wealth. But in telecom, there are only 2 or 3 players, and yet it's the ultimate wealth destroyer. So that is the difference of what the competitive landscape can do. So cigarettes, it's almost monopolistic or duopoly, and that's why 5 out of 5 goes to, and that's how you produce an ITC or VST or those kind of things. Then you have look at aviation. Everything is haywire. Whether price of fuel, whether number of entrants, government regulation, I mean everything, and the competition. I mean one flight goes empty, and they slash the rate so much that other guys also bleeds. So clearly this industry, at least so far in India and world over, aviation is the part of life of everybody. And yet, there is no company, every 5 years, the whole set of existing airlines, except for one or two, everything goes bankrupt and you get a new set of companies. So that is cigarettes, they are same companies for last 50 years, aviations, every 10 years you have a new set of companies. Value migration, this has been another very powerful force. The industries which are value migrating, those industries produce a very consistent business opportunity and hence consistent companies. Like IT services, we talked about it, pharmaceutical from India to rest of the world, banking from state-owned to private sector, telecom from fixed line to wireless, gems and jewelry from organized to organized, and aviation from full service to discount. So you see only Indigo has been some kind of a stability, but even that is kind of lost a lot of money in this COVID time. But still, I think from full service to discount is the way to go in India. Government regulation. We have seen what has happened to the oil companies and many other companies in that sector. They wobble when they get benefited also and they suffer also. But it brings volatility. Market doesn't like even positive volatility, because when the positive time comes, they don't get the valuation because they keep waiting for the negative times to come. So that has been the government has been one of the big interventions. It has been reducing, but wherever it is there, I think that is making a lot of difference. Then company-specific factor. So you got to have clear strategy and execution. You got to have clear goal. The companies which have clear goal, where they are headed, what they want to do, their focus, not diversified, and very sound strategy, very clear path to the goal. And then, of course, 1% is strategy and 99% is execution. The guys who have that good execution, they have good team, good people, and good leadership. I think those are the companies, when you meet them, you can feel it. You know, like Astral, Balkrishna Industries, Page Industries, Aisha Motor, they come in all the, I can tell you stories after stories, and this is an opportunity to, really identify the companies which have a very clear strategy and execution. This execution prowess is almost a must for any company to become large, consistent companies. Though it is very difficult to explain in numerical terms, but they reflect in the high ROC, better cash flow, better turnaround of the assets. Everything is visible, and from there we go and ask the companies what it takes. What is that magic formula for these companies? Industry leadership. The sustained consistency leads to leadership in the industry. So what we have seen, all the leaders are not consistent, but all the consistents are leaders. So leadership is one of the very important traits, because as you become leader, you have the bargaining power with the supplier, with the customers, and even the smaller companies, they find it difficult to fight with you pan-India basis. So UltraTech is the great example of a very high number of companies in the industry, and yet because of their sheer leadership, they have been able to create a consistent financial environment. Pricing power. Again, it's all correlated to the leadership and good competitive landscape. You end up finally getting pricing power. This is the final thing which actually helps the companies make. Ultimately, companies are nothing but they are the agent of customers. They buy on behalf of the customers and they sell on to the customers, because all the costs are belonging to the customers. They only look at the margin. So the companies which have that capability to pass on all the costs and drive their margin are the companies like Hindustan Lever and all. They deal in commodities, they sell the brands. So that's where the pricing power comes, and this is one of the biggest things for creating the companies consistency in the companies. Polyplex, catering to the same FMCG segment, but they don't have control over what they make or every ton of plastic process. And that's why you see the volatility in their earnings and all. Capital misallocation. This has been, this is very important. Early stage, all the entrepreneurs, they are very, very disciplined in allocation. But as they become successful, they become overconfident and they end up chewing much bigger than what they can actually handle. So we have seen the examples of Tata Steel and say Bharti Zen and even Hindalco to start with. So all these large global acquisitions, they have not done particularly well for these companies for the last 10-15 years. And my sense is that this particular thing has taught Indian companies to avoid, because the bankers are very smart. from Europe and America, and they bring all these companies with a very, very low-cost money attached with that. And so all these Indian companies initially they got, so capital misallocation, even in India, you might end up diversifying into something else which is capital intensive, though you have made money from some other profitable venture. So capital misallocation or can actually, it can dislocate the consistency of the company. So these are the thought behind the consistents and volatiles, but what are the number behind? So this is the summary of what we have done. So we ran these 700 companies, 697 companies. So maximum number of profit degrowth is 3, 0 bucket, 1 bucket, 2 bucket, 3 bucket. So maximum is 3, and anything more than 3 downgrades beyond 10% are called volatiles. And we have done it right from 3 to 15, and all these 583 companies are volatiles, and number of stocks in consistent are 114. So look at the percentage, 16% are consistent, 84% of the companies are volatiles. And of that, 87% among the consistents, 87% of the companies are outperformers, and only 33% of the volatiles are outperformers. And underperformers are 13, and balance is 67% underperformers. But look at the return. The Nifty return in this period, 15 years, 9%. The return of this is a little wrong. I think the return is 20% for consistents, and 2% for volatiles. They've written ROE, but the return is actually 20%, and here volatile return is just about 2%. So basically, most of it doesn't mean that all the companies are low return. There are the companies in volatiles also which have done well, but as a bucket, they have done very badly. In fact, bulk of the 95-97% of wealth is created by consistents as a group. So then we said wealth cannot be created only by consistency. There is always a role of growth. So how they have done in growth metrics, and consistents with low growth fared better than volatiles with high growth. So we said on the y-axis, we said above 20% growth and below 20% growth, and volatiles and consistent. Look at it, right-hand corner, top is the best, consistent and high growth. Of course, consistent and high growth is supposed to be, is a very logical. But second thing I thought was that volatile but high growth would do very well. But that's not the case. Consistent with a reasonably low growth, 10, 12, 15% growth, has done better than more than 20% growth from the volatiles. So that's the thing. The real money is to be made in the even low growth, moderate growth. If you get high growth consistently, of course you are going to make tons of money. But if you get even moderate growth of 10, 12, 15%, you are going to win in a marketplace. And during this period, the market performance has just been about 9%. So on the same framework, we looked at the sectors also. So same methodology to classify sectors as consistent or volatile. And here, 18 sectors, starting from I was surprised to see the sectors which are consistent. Agrochemicals, auto ancillaries. Automotive itself is volatile, but auto ancillaries, because they have the after-sales market, they have done much better. Banks, private sector has done well, public sector is completely volatile. Cement, chemicals, cigarettes, credit rating agencies, diamond and jewelry thanks to Titan, engineering, finance, FMCG, IT, logistics, oil and gas, just the Reliance, paints and varnish, pharma, refineries, and utilities. So just about 18 industries. Be careful. There are a lot of industries per se, they are extremely volatile. And sectors with not even a single, consistent company can come from a consistent sector, and it can also come from volatile sector, though the percentages will be lower from the volatile sectors. But there are sectors from where there is no consistent company. Koi mai ka lal nahi isme se. So, like air transport, alcoholic business, I'm surprised. Banks, public sector, bearings, cables, your shipping, sugar, telecom. I'm not saying this has been the history of last 15 years. The next 15 years could be somewhat different. But core thought process that these are the unreliable sectors. These are the sectors which are not consistent. That will remain. I don't think fundamental character is going to change there. Then we looked at the sector and companies kind of interaction. And here we looked at a consistent sector and volatile sector, consistent company and volatile companies. And here we thought consistent sector and consistent companies will do the best. No, consistent companies from volatile sector, because they have to fight again, double the industry headwind as well as whatever is the competitive headwind. So they have done better than the companies. There are 31 companies which are, I would say, they deserve a special mention. They have done better than consistent and coming from the consistent industry. And those 31 companies are all here. Astral, Page Industries, TTK Prestige, Eicher Motor, Kajaria, Whirlpool, Supreme, Balkrishna. They're all the companies which are from fundamentally like Balkrishna industry. It is from tire industry, which is God-forsaken. I mean, it goes from loss to profit kind of thing and very volatile in terms of profit making. But Balkrishna has been a continuously profit making company. So like that, in textile, Page Industry is the star, and all the other companies, large old companies, they have been kind of all over, up and down. Yeah. So reconfirming the findings, we said we have done the 15-year study. Let's look at 10-year rolling. You know what happens in 10-year basis, because it gives a recency, and we said let's look at this one. Really staggered us when we saw the data. So this is a 10-year rolling, all the companies, and across all the market caps, we have defined. So this is a 10-year rolling, consistent, and there are two drops in this thing, but definition remains same. Large, mid, and small. All the companies, in all the buckets, the consistent ones have outperformed. Just look at the down below outperformances. As like first year 13%, alpha is, I mean for the group 22%, alpha is 8%. Like that, if you go and keep seeing all the years, all these companies have outperformed. As a bucket, I'm saying, as a group. And every single bucket has been outperforming. There is no year, there is no conflict anywhere. And look at the other side of it. This is about the consistence. Look at the volatiles on a 10-year basis. Every single bucket in every single reading, it is underperforming. So this is kind of a sets at rest that the power of consistency versus weakness of volatiles. I mean, it's not that we can forecast every single consistent companies, but when we get one, we should really use it as much as possible, because this particular statistics is absolutely stunning. So then we said, okay, we have seen 15 years, 10 years. Let's look at what happens in 3-year basis, because life is not about 10 years. Life is about 3 years. Here, I think there are a lot of people who are bothered about next 3 days. So we have to, but then there is no investing for less than 3 years. So we looked at 3-year data also. So here what we did, like 2000, 2010, we said, let's take 10 years data. And then we said, next 3 years, what happens? So between 10 to 13, what has happened? So if it is consistent CC, means consistent in the first block and consistent in the second block, it has done about 12%. But hold your breath. When it is volatile and it gets converted into consistent, it is 15%. But if it is consistent company which becomes volatile in next 3 years, it is minus 8%. And if it is a volatile company, remains volatile, it has gone to gutter, it is minus 11%. Like that, we have done all the iterations. And so here is a summary of all the 12 iterations. The average is, if the industry has done about 9%, Nifty has done on average 9%, the companies which were CC, consistent to consistent in next 3 years, is 21%. And from volatile to consistent, it is expected that yes, it has to be highest. It is 28%. And the next two are just about 2-3%. So anybody would say that I would like to buy a useless company which is going to become great, because all the analysts, they give you a story of this company, this useless company is going to become great company, and it never happens. So the probability of making 28% is very low. Probability of making 21% is very high. So you have to figure out where is the payoff matrix in your favor. I think payoff metrics, when the consistent company, that's why Reliance and HDFC Bank, for some time they might look, they are not making money, but they come back and make up for all the past, slowdowns, and they make all the money. So consistent companies remaining consistent, if you are lucky to forecast consistency, are the companies to to go with bulk of the time. And 31 out of Nifty companies, I mean, just on the same breath, 31 out of 50 companies, accounting for more than 72% of the market cap, are consistent. I told you the list is out here. When you take the report, it will all be there. So how to create wealth? Now, everybody is now brainwashed for consistent and volatile, but how do we make money? Because that's the real thing. So, so then there is another framework which we were kind of looking to, encash on. That is a framework given by Peter Oppenheimer of Goldman Sachs in his new book, Top Buy. So here he's talked about, earlier we used to think that there are only two sentiments in the market. One is greed and fear. But here he has made it despair. This phase is bear phase when the markets are falling. Second is hope. The moment market fall stops, then the hope rally starts. The day on which Modi ji declared the lockdown, that was the bottom of the market. The hope rally started the day on which he closed the country. Then from there, the growth phase, and then the optimism. So psychologically, investors do commit mistakes in two phases. In the pessimism, they break down, and in despair, valuations are created. Earnings are bad, but the P multiple drop to the lower earnings. And in optimism phase of the high earnings, people end up giving the high multiple. And that's where the investor psychology needs to be understood and studied a lot more, which we'll take up in the next study, probably because EPS growth, EPS has been studied a lot, but not so much the multiple changes. So we will come back with a little more deeper study next year, but right now, the consistent and volatile framework has to be combined with the despair and the growth framework. And here, in the entry strategy, when your earnings are predictable, you must use the profit and loss based, profit based, or cash flow based, DCF based valuation tricks. And when it is unpredictable, you have to go to the balance sheet and you have to use the asset based valuation, that is price to book, price to capacity. I mean, if the book value itself is zero, then you have to use the capacity. I have 5,000 rooms, or I have a breakup value basically. I have a 500 planes, or whatever you have. Or price to sales. At least your sales you have. You don't have profit, but you have sales. And then price to, so you have to use the price to capacity. You have to stay away in volatile companies to value it on the earnings based. You have to value it on the capacity based. And also, if at all, buy only large volatile companies, but consistent, you can buy as small as possible. So odds of generating alpha, if you buy below median P multiple or below median book in consistent and volatile, is very high, but investing is a lot more creative stuff. You have to be careful in using these tools, but they do give you opportunity to buy at reasonable prices if you buy below book or below median book or below median P. And thanks to a lot of software, you can now see 15 years of median P and price to book on almost like literally free in screener kind of apps. So exit strategy, consistent investors. Now here is the real change. In consistent companies, you can be buy and hold. But in volatiles, you must sell when appropriate price comes. And appropriate price could be 3, 4, 5, because you'll make money very rapidly. When you make money, the story changes because earnings come there. And then people say that earnings P multiple is low. Don't fall for it. If you have made money in volatiles, run, because it is going to collapse. And quite possible in some cases, you may miss the top, but you have to sell too soon. But you have to sell in volatiles, but you may not sell. I mean, you may have buy right, sit tight kind of situation in a consistent companies. And so some of the ideas we have put here, and for consistents as well as volatiles, you can see in the report. And so conclusions, the financial sector coming out of despair will continue to dominate wealth creation in the foreseeable future. There are only two types of companies, consistents and volatiles. Consistency is source of outperformance. So every period of consistency is a source of performance, and volatility is a source of wealth destruction. Excellence in execution is non-negotiable consistency. Buying below median valuation tilts the odds in favor of the investor. And let me just leave you with one thought. India is the ultimate consistent country. where your GDP, underlying GDP is growing at about 12%. In this first half year, it is 16% growth. So this is a country which gives you like a fantastic bedrock for wealth creation. So with this, you expect bigger and more number of consistent companies coming from Indian corporates, particularly from private sector. So all the best for a fantastic wealth creation through consistent companies. Thank you.